The story you've been sold is that crypto is a massive, bloated market that's about to pop. The reality is something else entirely. The gates are not closed. They are wide open. It is right here, right now. You glance at the Bitcoin price, which not long ago shot well over $120,000 before taking a nosedive, and you think you missed the boat. You scroll past the headlines, the dizzying charts, the endless noise, and a single crushing thought takes root. The ship has sailed, and I'm left behind. The once-in-a-generation chance to build life-changing wealth is gone, and you're just left on the shore, watching the lucky few sail off into the sunset. That thought, that feeling of being left behind, it's a lie. It is, without a doubt, the single most destructive myth in finance today. It's a myth designed to keep you on the sidelines, paralyzed. It's the myth that keeps you poor. Because while you've been mourning a lost opportunity, you've been completely blind to the real one taking shape right in front of your eyes. We're going to tear that lie apart, piece by painful piece. I'm not here to sell you hype or speculative garbage. I'm going to show you hard data, huge institutional shifts, and technological breakthroughs that prove the last 15 years of crypto were just the wild, messy dress rehearsal. The main event, the part that will truly reshape our financial system, is only just getting started. And by the end of this, you'll understand that the biggest opportunities aren't behind us. They are without question still ahead. Before we can debunk this myth, we have to respect how powerful it is. The feeling of being too late isn't crazy. It's a perfectly human reaction to seeing a chart that seems to have gone to the moon and back. When you see an asset that has rocketed from pennies to tens of thousands of dollars, your brain's internal alarm system screams, "This is the top, the growth is over." It's a defensive mechanism, trying to stop you from buying into a bubble just before it pops. We call this fear of missing out, or FOMO. This feeling is cranked up to 11 by a few key psychological traps. First is something called unit bias. Our brains are just wired to prefer whole things over tiny fractions. It feels wrong to spend, say, $1,000 to own 1% of a single Bitcoin. It feels like you're buying scrap. On the other hand, buying 1,000 shares of a $1 stock feels substantial, like you own a real stake in something. This is mental hiccups, and it makes assets with high prices seem expensive and maxed out, even when their total market value tells a completely different story. It tricks you into looking at price instead of potential. Second force is the media narrative. Financial news, by its very nature, is a rear-view mirror. Headlines celebrate what already happened. They tell epic tales of the Bitcoin millionaires who got in at $100. This constant focus on the past creates a powerful illusion that the story is over. It frames crypto like a gold rush where all the biggest nuggets have been found. The subtext is always the same. You weren't there and you missed it. But the biggest mistake, the one that holds up this entire myth, is a failure of imagination. We instinctively try to compare crypto to things we already know, like stocks and real estate, but those are mature centuries-old markets. The New York Stock Exchange was founded in 1817. People have owned land for millennia. When we use the rulebook for these ancient systems to judge a 15-year-old technology, we make a catastrophic mistake. It's like looking at Amazon.com back in 2005. By then, its stock had already exploded over 10,000% from its initial public offering. Countless analysts and investors looked at the chart and declared the party was over. They saw a successful online bookstore, but they couldn't imagine it would become the backbone of the entire internet, a global logistics empire, a movie studio, and a leader in artificial intelligence. Their imagination failed them, and it cost them a fortune. That's exactly where most people are with crypto in 2026. They see the price swings, hear the stories of past fortunes, and apply the rules of an old, slow world to a new, fast-moving one. They're mistaking the end of the chaotic Wild West phase for the end of the opportunity itself. But this feeling, this myth, is built on a foundation of sand. It comes from a total misunderstanding of three things: scale, adoption, and technology. And when we swap feelings for facts, the whole story flips on its head. Let's switch from feelings to figures. The story you've been sold is that crypto is a massive, bloated market that's about to pop. The reality is something else entirely. Let's break this down into 3 truths that show just how early we still are. Truth number 1, the scale is still shockingly small. Your perception of crypto size is distorted. You hear about high Bitcoin prices and assume the total market is gargantuan. Let's get some perspective. As of early 2026, the entire crypto market has a total value of around $2.4 trillion. Bitcoin, the biggest player, makes up about $1.4 trillion of that. Now that sounds like a huge number, and it is, but in the grand scheme of global finance, it's barely a blip on the radar. Let's compare it to gold, humanity's go-to store of value for thousands of years. With gold prices now over $5,000 an ounce, the total market value of all gold ever mined is estimated to be over $30 trillion. Let that sink in. The entire crypto market, the one people saying is too big to grow, is worth less than 10% of a shiny metal we dig out of the ground. If Bitcoin alone were to simply match the value of gold, an asset it arguably improves upon by being more divisible, portable, and verifiably scarce, it would mean a price of over $750,000 per coin. And that's just to catch up to gold. But even gold is a small fry. The global stock market is valued at over $100 trillion. The global real estate market is estimated to be worth over $300 trillion. If all the world's assets were the Pacific Ocean, real estate would be a continent, the stock market would be a vast sea, and gold would be a very large lake. In that picture, the entire crypto market isn't an ocean or a sea. It's a powerful river, still carving its path. To look at that river and say, it can't get any bigger, is a profound failure to read the map. Here's number 2. The smart money has only just arrived. For its first decade, crypto was a retail game, run by tech geeks, early believers, and speculators. The real giants of the financial world, pension funds, sovereign wealth funds, and corporate treasuries that managed tens of trillions of dollars, were stuck on the sidelines. There was no regulation, there's no insurance, or compliant way for them to get in on the action. That all changed in 2024 with the approval of spot Bitcoin ETFs in the United States of America. And that wasn't the end of the story. It was just the starting gun. Those ETFs built a simple, regulated bridge from the old world of finance to the new one. And the capital flowing across that bridge is already staggering. By early 2026, assets in crypto exchange traded products have surged past $190 billion. This isn't dumb money chasing hype. These are the biggest asset managers on the planet, like BlackRock and Fidelity, building massive positions for their clients. But here's the critical point. This isn't just the first trickle. Recent industry surveys paint a clear picture of what's coming, with the vast majority of institutional investors now planning to allocate capital to digital assets. Let's be clear about what this means. These institutions move like glaciers, not speedboats. They have committees, risk assessments, and multi-year strategies. The 2024 ETF approvals didn't make them instantly dump billions into Bitcoin. It made them start the process. That process is happening right now. Over the next 5 years, as these funds start making tiny 1 to 3% allocations from their multi-trillion-dollar portfolios, they're going to open the floodgates. The retail-driven phase laid the foundation. The institutional-driven phase, which is just beginning, will build the skyscraper. You are not late. You are simply arriving before the main construction crew gets to work. Here's number 3. The story is no longer just about Bitcoin. The final piece of this puzzle is realizing this revolution has expanded far beyond just internet money. While Bitcoin is carving out its place as digital gold, the underlying technology, the blockchain, is getting ready to upgrade the entire global financial system. And this is where the most explosive growth of the next decade is set to come from. 2 key developments are powering this: the tokenization of real-world assets and a rapid maturation of the technology itself. They are the unseen engines that will drive the next chapter of this journey. If you've been nodding along, recognizing how the old myths of too late are crumbling under the weight of scale, institutional adoption, and technological evolution, but you're hungry for more actionable insights, deeper dives into real-world assets, protocol upgrades, and personalized strategies to build your crypto portfolio, then it's time to level up. Join the Numeratus.us community at numeratus.org for just $100 a month. Get exclusive access to our members-only articles, our podcasts, our Q&As, in-depth analysis on wealth maximization, and a network of like-minded visionaries magnetizing money while minimizing risk. And yes, it counts as a business expense. Don't just watch the revolution, lead your piece of it. If you're only watching the price of Bitcoin, you're missing the two biggest stories in finance today. These are the developments happening behind the scenes, building the plumbing for a tokenized global economy. They're the reason the growth we've seen so far is just the prelude. So catalyst number one, the tokenization of everything, real world assets. This is the multi-trillion-dollar revolution that is just starting to hit the mainstream. It's called Real World Asset Tokenization, or RWA. The idea is simple, but the consequences are massive. RWA is the process of taking traditional assets like stocks, bonds, real estate, fine art, or private credit, and issuing a digital token on a blockchain that represents ownership. Why do this? Our current system for trading these things is ancient. It's slow, expensive, and clogged with middlemen and paperwork. It can take days to settle a simple stock trade. Selling a small piece of a commercial building is particularly impossible. Tokenization fixes this. By turning an asset into a digital token, you can trade it 24/7, instantly, anywhere in the world for a fraction of the cost. It enables fractional ownership, meaning you could buy $100 worth of a Manhattan skyscraper or a stake in a famous painting like the Mona Lisa. It unlocks liquidity in markets that have been frozen for centuries. This isn't some sci-fi fantasy. It's happening right now. Financial giants are all in. BlackRock, the world's largest asset manager, has already launched a tokenization fund on the Ethereum blockchain. Their CEO, Larry Fink, couldn't be clearer, stating, "I believe the next generation for markets, the next generation for securities will be tokenization." Can't be any clearer than that. The forecasts are mind-boggling. Boston Consulting Group famously predicted that the real-world asset market could hit $16 trillion by 2030. Other analysts have even bolder projections, seeing a potential $30 trillion market. To put that in context, that would be like the entire GDP of the United States migrating onto blockchain rails. This changes everything. Crypto is no longer just about building an alternative financial system. It's about fundamentally upgrading the one we already have. Catalyst number two, the evolution of technology. The second major catalyst is that tech is finally growing up. The early days of crypto were slow, expensive, and a nightmare to use. Bitcoin can only handle a few transactions per second. Early Ethereum was plagued by fees that made most apps worthless for the average person. Critics correctly pointed out that the tech just wasn't ready. But that's changing, and it's changing really fast. The blockchains of 2026 are not the blockchains of 2017. Look at Ethereum. The Denkun upgrade in 2024 was a game changer, slashing transaction fees for its scaling solutions. Then, the Pectra upgrade in 2025 further improved staking and account flexibility, and the roadmap doesn't stop there. Upgrades planned for 2026, like Amsterdam, are set to tackle even bigger challenges like transaction parallelization to make the network faster and more efficient. This isn't just geek speak. These upgrades are what make real-world use possible. They're what will allow decentralized finance to handle millions of users and will support tokenization of those trillions in real-world assets. The technology is finally catching up with the vision. Catalyst number three, the slow march towards regulatory clarity. For a decade, the biggest roadblock for crypto, especially in the United States, was regulatory chaos. Institutions couldn't invest because they didn't know the rules. Builders were scared to innovate for fear of getting sued. That era is ending. While we still don't have one perfect rulebook, the direction is getting clearer and clearer. We are moving from hostile enforcement to pragmatic regulation. The approval of spot Bitcoin's ETFs in 2024 broke the dam. Then in 2025, the passage of the Genius Act created the first federal framework for stablecoins in the US, effectively legitimizing them as a core part of the financial system. Now, discussions around a broader market structure bill, like the FIT21 Act that passed the House, continue to move forward, aiming to clarify the rules of the entire industry. This shift is globally significant. As the world's largest economy writes the rules, it gives global institutions the confidence to finally commit serious capital. Regulatory clarity isn't a threat. It's the single greatest catalyst for institutional adoption. It's the final green light the world's largest pools of capital have been waiting for. After all that, I need to be crystal clear. Does this mean you should take out a second mortgage and go all in on crypto? Absolutely not. Anyone who tells you that is selling you a dangerous fantasy. The point here is not to erase risk, but to reframe the opportunity. The reality is that this asset class is and will be for some time an incredibly volatile beast. Prices can and will have gut-wrenching drops of 30, 40, or even 50%. Scams are everywhere, and thousands of projects have no real value yet. The chance of a total loss on a specific investment is very real. This is the frontier of technology and finance, and the frontier is always a dangerous place. But the fear of that volatility leads to the biggest mistake most investors make: trying to time the market. They wait for the perfect time to buy, get scared out during dips, and chase pumps during rallies. It's a guaranteed way to lose money. So how do you handle the volatility? You do it with simple, boring, but profoundly effective strategies like dollar cost averaging. The concept is extremely straightforward. You commit to investing a fixed amount of money at a regular interval, say $100 every week. When the price is high, your $100 buys you less. When the price is low, your $100 buys you more. Over time, this strategy automatically makes you buy more when things are cheap and less when they're expensive. It smooths out the terrifying ride, and most importantly, it takes emotion out of the driver's seat. Your focus shouldn't be on becoming a trader. It should be on becoming a long-term accumulator of high-quality assets. For most people, that means sticking to the most established, decentralized, and institutionally recognized networks, Bitcoin and Ethereum. These are the blue chips of the digital world. Start small. Invest an amount you would generally be okay with losing. Automate your purchases so you don't even have to think about it, and then zoom out. Your goal isn't to get rich by next Tuesday. It's to build a position over the next 5 to 10 years in what could be the most important technological revolution of our lifetimes. If this video has shifted your perspective, if it made you question the idea that you're too late, then consider subscribing to the channel. This conversation is just getting started. In the coming months, we're going to explore each of these catalysts more and more, from specific RWA projects to the nuts and bolts of the next protocol upgrades, to give you the knowledge you need to navigate this space with confidence. And I want to hear from you. Drop a comment below. What is the single biggest fear or belief that has held you back from crypto? Was it the price, complexity, the risk? Every single comment provides feedback. Myth that it's too late for crypto is more than just bad advice. It's a self-fulfilling prophecy that keeps you on the financial sidelines. It's a comforting lie that lets you avoid a complex but transformative new reality. And it primarily benefits those who are already invested. But the gates are not closed. They are wide open. We are not at the end of the crypto story. We are standing at the very beginning of the tokenization of the world. The early days of the wild speculation are giving way to a new era of utility, institutional adoption, and real-world infrastructure. The question is no longer if you should have exposure to the asset class, but how you can do it intelligently. The opportunity of a generation did not pass you by. It is right here, right now. Don't let a myth keep you from seeing it.